trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, welcome back, Market Rebels once again. And yes, it is morning. It is Thursday morning. We're going to be airing at 4 p.m., but for other reasons, we had to get this recorded early. So I don't have a little market update here on the close. But Stu, how are the futures? A little down this morning, aren't we?
Just a touch, down about 1/3 of 1%. Not a
Oh, okay. Yeah, not much. But we got some economic indicators coming out. Actually, it's 8:35. They've already come out. So we'll have to see how we close. But down a little bit here on for the opening bell, looks like. So for today, for Coach's Corner, we have another cool topic. And Stu, this one, I know I try to keep you in the dark on what the topics are, trying to challenge you here a little bit. But I got this idea from, we had a conversation recently, and I know you do a lot of coaching. You said it's something that a lot of people have been asking about, and they seem to be out in left field about what this really means. Is a, ready for this? Cash secured put.
What a joke.
So we have, yes, it is an actual strategy. It's and we're going to talk about the pros and cons of it. But there's an interesting aspect that you brought up, and you said that there are people who think that it somehow is reducing the risk.
Yeah, and that's the thing that I hope that we're going to go into here. It's just this notion that somebody says, I hear it all the time. Says, "Well, I'm selling this put. Well, what's your downside?" Well, I'm cash secured, so, and then they go into this
It doesn't
dialogue.
matter.
It doesn't really matter where the stock goes because I'm secured. I'm cash secured. I mean, what's
Right.
better than cash? Cash is king. And this whole notion of like, where's the risk and how's it going to affect me seems to be misguided by this term of cash security, which is really, in my opinion, just a marketing term used to, I don't
Yeah,
know,
it's
something with margin or I mean,
yeah, we're going to talk about that. So I think it's true really for all strategies that yes, there are pros and cons, but you have to understand, first of all, what are the risks? What is it designed to do? Is it in line with your goals and what you're trying to do? And just to understand the mechanics of it. So we're not saying that there's anything wrong with a cash secured put
no, no, not at all,
or even a naked put for that reason.
not
We're
at
just
all.
saying you need to understand that that word secured is probably not being used in the way that you think it's being used.
Correct, correct.
So let's talk about that. Cash secured puts, myth versus reality.
Huh.
We do think this is a big myth, right? Like our Loch Ness monster friend over here, because we do hear this all the time. We get it once in a while in Q&A, but again, I know you get it a lot in coaching. So
Saw one
let's
of those Loch Ness monsters in the swamps in Jersey back here. That's a whole
yeah,
time. That guy's big.
can only imagine. So let's start off with our chalk talk. Little thought-provoking question we want people to think about. We'll answer it at the end. So you sold a cash secured put. And again, that is the name of a strategy. And the question that we have is, do you have less risk compared to a naked put?
And Bill,
Because,
I gotta tell you, the question here
Mhm.
nails nails it.
Yeah,
This is what the issue is. Again, everyone, it's not about should you sell a put, should you not sell it. It's
correct.
not
No,
about that. It's the inference about where is your risk and how can it affect me, and what is this term doing for me, or
right. Yeah, well, and it's like I said, it's in so many things with options. People hear a little sliver of it and they assume they understand all of the mechanics of it and how it works. But I think most people know that a naked put is among the riskiest. Naked call theoretically would be, well, that's actually even up for debate, isn't it? Because stocks often fall faster and harder. You could make a strong argument that a naked put is really the riskiest, even though it has a theoretical downside of zero with the stock price. But people often hear naked options, calls, or put. Those are the things to avoid. However, they hear, oh, selling options, push button, get cash. I'm going to sell it way out of the money. No way the stock can come down here. Another myth. But they say, but you know what? I'm going to use a cash secured put, and that way it removes this risk. And that's the thing that we think a lot of people feel about the cash secured put strategy. So let's go kind of pull these apart here. We're going to start with the naked put. So this is a strategy where you just sell a put. Click on the sell button and sell it. Yes, you get a credit. But if it's a true naked put, it means that there is no hedge against it. So there's lots of ways we could hedge it. You might have short stock, be kind of the reverse of a covered call. Short stock, short put. If you short stock, you have to buy it back at some time in the future. The short put's going to give you the obligation to do that, and you'll get a credit for it. But my point is, or maybe you have a long put against it, but then it wouldn't be a naked put, but there's no hedge. It's just the outright sale of a put. And when you do this, you have unlimited downside risk. That's why the brokers have the highest level of margin approval in order for you to do naked options. Now, I know some people, little footnote here, some people always balk at this and they go, hey, hold on a second. Naked put doesn't have unlimited downside because a stock can only fall to zero. Agreed. It's more of something that it's just an industry way of saying it that the option itself is not limiting you. It's taking the full ride to the absolute limit of that stock. And also, it's pretty rare for a stock to hit zero. Does happen, but it's rare. So what we're saying is there's no real floor here. You're just taking the full potential downside risk. So just when we say unlimited downside, yeah, we know a stock can only go to zero, but we still call it unlimited. Believe me, if you get hit hard with a naked put, it's going to feel unlimited.
it's going to be really painful.
It can be horrifically bad. Now, here's another catch. Yes, you do get to push button get premium. And we talked about this in a fairly recent one with a covered call, which is synthetically the same thing as a naked put. Synthetically means it has the same risk graph. You can't tell them apart. But the thing is that yes, you get the premium, but you don't really realize the cash immediately. You can't sell that put for 3 and say, send me a check for $300 that I just collected. Now you could do that, and they're going to pull it out of margin cash available or maybe actual cash, but they're not going to do it from the premium that you generated here.
Which,
You
which
have
is which is a little bit of a myth in and of itself. Push
Yes, it
button,
is.
sell call, sell put, get cash, take money.
Nope.
That money has a value, and that value is part of the position. That's called your mark to market. And until that actually is closed at either a profit or a loss, then it might become, if it's profit, then it'll become real money, and then it's
Or expires worthless. Right,
or
correct. But
expires.
that's the point. You have to wait.
Yeah.
You can't just say, I sold that put for 3, send me a check for 3 or 300. So there's an example that we're going to use. We're going to sell this and we're going to assume it's a naked put for $3. So what's our risk here and why do you have to wait to collect this 3? So before we take a look at that, remember, please everyone, free stuff here. Gotta like free, marketrebellion.com/get started. Lots of free stuff, videos, articles on topics just like this to help you make better sense of sometimes confusing options market. So here's the risk graph from our strategy. We just talked about selling this naked put for 3. So remember that whenever we have an option, long or short, that we always get a bend at the strike. So for anybody who's brand new, that's kind of your first lesson on risk graphs. You're always going to bend at the strike. That's showing that we have some type of a hedge in place. Now you might not know if this is a call or a put, but you can see it's the 100 strike. So here we've sold 100 put, and if the stock price goes up, no matter how high it goes, what's the most we can make? The amount we received. Now it looks like I used a different slide here for it. I'm sorry for that. It looks like this was sold for 5, but for the previous example, that would just line up at 3, but it would have the identical shape. So no, that's the most you can make is the premium collected. But notice what happens down here, Stu. What are we doing?
Looks like you got unlimited losses. don't you?
We're taking the full ride to the downside, and that's the part that a lot of people misinterpret because they say, well, there's no way the stock is going to hit 85. And they say, so I'm not really even going to pay attention to this. I'm just looking at this cash that I'm getting here. But again, are you really getting the cash today? Well, yes, you do get credited for it, but in the business we say it's not realized. So yes, your money market's going to show in this example now for a $500 credit, but you can't just withdraw that 500, at least not yet. Because
So if I go out into on the opening here in booking
mhm,
and I sell a 7,040 put, stock's 5,600, and I collect 2940 to
yeah,
2,940 and add 2 zeros, 294,000. I'm gonna just call up Charlie Schwab and say, send me a check. Is
that
that
makes
cool?
not happening.
Come
Right.
on.
That's
What do
actually
you
a very good that's actually a very good way to show it. You should go, that just doesn't sound right. It's
push button sell cash. I mean, you
right.
push button get
It's
money, credit. Aren't they gonna put that money in my account so I can now do what I want with it?
yes, but they're also going to hit you with a liability. They're going to have that's the part
Oh,
that people forget. Yeah.
that's not
So
that's
here's
not
the thing is that this blue line is the current curve. Those are the profits and losses right now today. The black line is only at expiration, let's say right on the or within seconds of that expiration date bell. So you're either delta 0, flat, maximum gain, or you're delta 1. And depending on where that stock is, and we'll see why that's important in a little bit, that could potentially be a very big loss. But we can see that the risk where we go under 0 is to the downside. See above our break even here in this case of 95, which is the 100 strike minus the $5 premium, we're okay, we're above water. We get above water at a maximum level at 100 or higher. But down here, this is a part that people forget. So no, it's not worth 5 right now to you. So right now we can see that where this blue line, maybe it's worth a couple of bucks. We still have this liability because there's time remaining. So let's say this is 30 days to expiration on the blue line. 5 days later, all things being equal, that blue line is going to start working its way towards the black. Remember, the black is the expiration bell. And that's what everything, it's like a gravitational force pulling our risk graph that way. So there's with 25 days. And what do you notice? It became a little more valuable. It was only worth maybe again a couple of dollars to us now. Now it's worth 2 and some change. And that's because the stock is still at the same price, but time has passed. Now if the stock had gone up, yeah, you're worth here, whatever that value is on the orange, you're real close to 5. And if the stock came down here, you're underwater. So 5 days later, let's say 20 days to expiration, we move to the gray, another 5 days, another 5 days. We keep moving closer. So this green line is 5 days until expiration. And then of course, if we wanted to, we could go day to day or hour by hour and keep moving closer. And right on that expiration bell, what happens? Bang. Now you've collected or at least earned that full credit. So even though it was deposited to your account in your money market, in this example, $500, you didn't realize that until the passage of time. So that's another big insight. Yes, you can push the button, you can get immediate cash, but you're not going to receive it until you either close it or it expires worthless.
Or if the stock moves in your direction and it goes down to zero or 10 or 20 cents, whatever, and until you buy it back, right? Until you buy it back
Until that position's
at whatever
closed.
price it is, it's not a realized gain and you can't
And
really touch
correct. And the only other way to not buy it back is it expires worthless, but it's
it.
still closed. Closing it, let's say, is probably the better way to put it. But the point is that you have to wait. And if you have to wait for 30 days, remember this guy down here. And now the more cash that you get, push button get $5 is good, but not as good as push button get $12. Well, if you do that, it's because it's a more volatile stock, and that means that this becomes far more likely. So it's all a balance of risk and reward. So where is this whole myth with the naked put versus the cash secured? So let's take a look at the margin for this type of transaction. So here's kind of a hypothetical listing of that you would see in your broker's platform. And let's just say, to make it easy, you have $10,000 cash, nothing else in the account, just to make the math easy. If it is a let's say there's a $2,500 margin requirement for this naked put. We've talked about that before, didn't we? Have a coach's corner on margin requirements.
Yeah, we did.
There's three different calculations. I'm not going to go into it here, but
Doesn't matter.
roughly 25% of the underlying stock. So let's say if it's
That's one. Yeah, that's one way. The 25% thing.
it's just a rough rule of thumb. But again, this isn't really even important for our purposes here. It's just that
No,
there's a margin
yeah,
requirement.
yeah, yeah.
And so what happens is that now you've got 7,500 in, let's call, actual cash.
Available cash, they call it.
They call it more exactly right. So if you requested a check, they're not going to give you the full 10, even though in your mind you're thinking, hey, I never took out 10,000. They segregate this.
Yes.
They put it in a little box off to the side and say, look, this is not available to you for check writing or for margin of stocks or anything else until this position either expires or is closed out. So we're going to separate it. So now you've got 75 actual cash. Sometimes they'll call it option buying power, margin cash available, check writing ability, lots of things it goes by. All right, so here we are sitting in our account. We also have a naked put. And now the stock, let's say, goes to 70. Uh-oh, that's not good because the stock is down. We just found that there's unlimited downside. So what's going to happen here? If you didn't close it out, you're going to get assigned. What strike did we sell? The 100. Each contract controls 100 shares, so that's $10,000. So the broker says, hey, we're just, and part of the process here, they don't call you and say, we just want to double check. Do you really want this to go through? Or you need to go clean this up. It happens automatically. Whether you want it to or not, they say, look, you took the assignment, you're long shares. Do you have the cash in there? Yeah. Now they'll blend it back and say, yes, you do have 10,000. But now what do you have? You've got 100 shares of stock worth 7,000. So what are you down here? You started your account with 10,000, it's worth 7. You're down 30%. Now, could it come back? Yes, but now you're holding the stock. Could it continue down? Yes. So you still have those unlimited deltas down, dollar for dollar, in this case with stock. So this is where people say, wow, naked puts are really, really risky. Maybe I should do a cash secured. So let's do this same example, Stu, with a cash secured put and see what happens. Before we do, quick reminder, marketrebellion.com/get started. All kinds of good articles and videos to help you on topics just like this. So the cash secured put, what's this guy all about? Well, again, as we talked about, it sounds less risky.
But Bill, can we take a minute and just talk about that for a second? That's kind of like my beef here.
Yeah,
Cash security
exactly.
sounds less
Yeah,
risky. And it does sound
it
less
does.
risky
Yeah, it's
because
secure.
it has the word cash in it, and of course, cash is king. And hey, we got cash, so we're good. And then secured. I mean, what's
It's
better
secure.
than secured? It's
Right.
security. It's
And
comfortable.
secured with cash, right? We're not
And
secured with
secure with
Bitcoin. We're
cash.
secured with cash.
Yeah. So whether it's secured with a 25% margin requirement, whether it's secured cash, which is really just another way of saying it's 100% margin. it's still the exact same risk profile.
Yeah.
That one has nothing to do with the other. Yet there's this notion that it does, but in reality, that's the myth versus whatever we called it before,
Yeah.
versus reality. That it doesn't. It has nothing to do with it. One's purely a brokerage. How much? Hey, bro, how much are you going to put up to put on this position? And the
Yeah.
other one is, well, what's going to happen to the P&L as the stock moves around and as time goes by and all that other cool stuff.
Yeah.
They have to be separated. They're not
Yeah.
they're not more secured as far as risk goes.
Yeah, we'll talk about that in a little bit where that term is coming from. But the thing here again is that that's something, just a psychological effect, that the word control creates psychological comfort. People like to think that things are in control, right? One of the reasons that people like to read charts. So I can tell that the stock's not going to go here. I can tell that this is it. Those are comfort, like kind of like comfort food. They're psychological comfort for traders. Well, the same thing here with the word cash and the word secure. So let's go through the example again. We're going to sell a put. We have unlimited downside risk. You must wait to collect the premium. Everything's sounding exactly the same here, doesn't it?
I think so.
Except now you hold the full exercise price in cash. So the key word here is what? Full. As Stu said, the only difference, it's just 100% margin requirement. So I said that I would talk about where this word secure comes from. It's really to protect the broker. You could also make a small argument that it's to protect you. You're
Yeah, you
saying,
could.
you're saying, look, I'm just letting you know, Mr. Broker, I'm good for it. Here's the 10,000. I've got it. So if I do get assigned, it's not like I have to say, hey, give me a couple weeks. I got to go take out a loan on my house and get some cash from my credit card. I'm going to be in a world of hurt. I'm letting you know up front, I've got the cash. There it is. But
There it
it's
is.
really, and that's why a lot of times, like for an IRA, they will make you do a cash secured, because you can't say, well, I'll just journal money in. You might not be allowed to. They want
That's
to make
right.
sure that cash is in
You
there.
might be at your limit for the year.
Might be at your limit, and now you've got some real
Yeah,
problems.
yeah.
Probably have to go and bust the trade. So at any rate, let's go through the same example here. We're going to open up the account, and we got $10,000 cash. What's the margin requirement now?
No, what do you mean bust the trade? So if I sell a put at $10 and it goes to 20, I can call the guy up tomorrow and say, yeah, I forget it.
Yeah, no, you can't. Um, but they can in the brokerage world. They can just go back and kind
And
of.
that could happen, and you might have some grounds to get it busted. Uh, but you'll still have
I've
to.
seen that happen when I was on Active Trader. Four things just like this.
You'll
Usually on
still have to eat
IPOs.
it.
Yeah,
There's still going to be a number. Yeah.
yeah, they happen on IRAs and on IPOs. They say, well, it's going to IPO at 30. It opens at 70, and they go, well, we don't have the cash to pay for it. And so now at this time, the broker now requires a limit order on those, not just a market to say, oh, I read that it's going to IPO at 30. That's the primary market, not the secondary. Anyway, that's a little tangent, but yes,
Yeah.
it's to protect the broker. So what they're going to say in this case is they're going, okay, you want to sell this $100 naked put? We're going to hit you for $10,000. Why? We know that's the worst that could happen. It's a $100 strike. Doesn't matter where the stock is, if it's 90, or technically you can get assigned at 100, but let's say 99.99 or all the way down to zero, has no
Wherever.
bearing on it.
Doesn't matter.
You're
You,
gonna owe
you, you're
10,000
obligated. Read the terms of the contract, everyone. You have an obligation to buy stock at 100.
at
Period.
100.
Story. And
Right.
there it is. 100 times 100 is 10 grand.
And
Bang.
here's another one which we've talked about. What if the stock closes at 101? You still might have that obligation, because after the
Well,
bell,
you might get assigned.
yeah,
Yeah.
somebody, you could still get assigned. I've had people say, oh, they can't assign you. Oh, yes, they can, and they did. They can assign you at any time for any reason. That's the long positions, right? And then
I've
these
seen
traders, when I was talking to, they said, oh, but that doesn't make any sense. And I said, it doesn't have to make sense. It just
you. Doesn't have to
has to
make sense.
happen in your account for it to
Right.
matter.
I've seen 60 strike price puts. This is actually a famous case. It's
Oh,
not
yeah.
Federated.
Bear
60
Stearns.
price puts get assigned on a close of 63.
Oh, wow.
63 was the expiration closing price. and the 60 puts were assigned. I mean,
Unbelievable.
go
That's
figure,
that's a
right?
real rarity. Usually they're within pennies, but that does happen.
Well, look, I mean, you know what happens, right? The stock was trading at 56 in the after hours because of some
Yep.
court ruling. Bang, all the puts got assigned.
All the puts got assigned.
Yeah.
So the broker is just saying in this case, if you want to do this or you just choose on your own, I want to do it cash secured. Broker says, okay, fine. We're going to withhold $10,000 or 100% margin requirement. Remember on the previous one, we did a 25% margin requirement. So how much actual cash do you have now? None.
None.
Remember when I say that, it's not saying you have no cash in there, you have no spendable cash.
No available cash. No.
You can't say, I want to go buy stock
Buying
on
ground.
margin. Not there. I want to check. It's not there because it's being withheld for this put. So now let's go through the same example. Stock goes to 70. Uh-oh. That sounds like a bad thing. We have unlimited downside risk. We get assigned. How much do we have to pay? $10,000. How much do we have? Whew, good thing. It was sitting there nice and safely locked up. We do have the $10,000 for sure. No harm there. No having
So
to get a
let's go
mortgage
through the
on the
P&L.
house or take it out on the credit card. I know for sure it's there. What happens?
Let's go through the P&L on that real quick. So you pay, so it's there, right? So you put the money up, bang. All right, next, right? So now what happens? You have to pay 100, right? Because that's the obligation. It's 100
Yep.
strike price, but the stock's traded at 70. I guess in my world, I just lost 30 bucks, didn't I?
Yeah.
I mean,
So
that's
that's what
how.
happens.
But
They're
no
going to say,
matter what,
okay, we're going to take out the $10,000 for the assignment. Now you're the proud owner of stock that is marked to market that is worth 7,000. What's your
yeah,
return?
you lost 30 bucks. No matter
It's
how much you
exactly the
put up at
same
the
thing that we
beginning.
just, yeah, it's exactly the
Right?
same thing we just did with a naked put.
Suppose they said to you, we really like you, Bill, and we know you're good for it. This will never happen, by the way. But suppose they said, well, we know you're good for it. You don't have to put up squat. You don't have to put up anything.
Same
Don't put
risk.
anything. Here you go. Just go to town. And
Right.
and this happens. Bill is still on the hook for
It's exactly the same math. Right. The point to see is that no matter, right, like Stu said, that's a way of saying forget about margin. That's a man-made rule. The
yeah.
point is you sold 100 put and you got assigned. And if the stock, and how could we make it worse? Stock is 60. Now you're down 40%. Stock
It's
is 0.
really
Now
that
you're down
simple.
100%. You're just now the owner of the stock.
Yeah. Yeah.
So the whole thing with cash secured really just comes down to how much margin do you have to put up. If
And
you
that's
ever
it.
get confused, if somebody says it's a cash secured put, say, oh, you mean it's a 100% margin requirement?
Yeah.
And they'll probably look at you like, what does that mean? It's two different ways of saying the same thing.
Exactly.
That's all it
Exactly.
is. So whether we do cash secured, all right, here's our risk graph. Doesn't that look just like what we saw with the naked?
Well,
Looks exactly the same.
yeah, it
And the
does.
cash secured puts do not protect you from the downside risk.
No.
And that's the thing that we find that a lot of traders fall into. They hear the word cash and secured, and they somehow think that this has been blocked off.
And it's crazy. I mean,
It's been blocked off to the broker, but you're still the owner of it.
Yeah. Yeah. I know. You and I talk about this every
Yeah, we
once
get
in a
we
while.
get it all the time.
Bill says to me, I just can't believe that like actually is how some
People
people
interpret it, yeah.
think about this. And I say to him, yeah, I can't believe it either, but I'm telling you, it's true. And he says, yeah, I know.
And
I
that's
agree.
okay, right? It doesn't make sense to us because we're in the brokerage firm. At one time we had to learn this, and at one time it might have been kind of like, wow, that's a surprise. But after you've been doing it forever, you're going, how could somebody not see this? But that's why we wanted to bring it to you, because we do find that a lot of people think that there's a very big difference between a naked put and a cash secured put. There's a very big difference in the margin requirement, but that's just a margin requirement. Forget about that. The risk is identical. The risk that you're
Identical.
exposing yourself to is identical. And
Identical. Completely.
that's the thing to understand.
Yeah. Yeah.
Yep.
That's right.
So let's revisit Chalk Talk here. You sold a cash secured put. There it is. It's secure and it's secured with cash too. Do you have less risk compared to a naked put? What is the only answer here?
Yeah. It's the same. No, no.
Exactly.
So this answer is a little different than our usual. Well, maybe, right? Because it's not. It's just this is it. It's
This is
P and
it.
L is P and L, right? You make, you lose. You sell them at 5. You go to 2. You make 3. You sell them at 5. They go to 10. You lose 5. That's the way it is. Period.
Right. Right.
It's not more complicated. But and then there's the other story. Well, how much do I have to put up to put that position on? Some people have to put up 100%. Some people have to put up 50%. Some people
Yep.
have to put up 25%. Some people have to put up 15%. When I was on the floor, we had to do a 15% margin. We had professional portfolio
Yeah.
margin.
Margin.
We
Right.
had to put up 15%, and we had a ton of money. I mean, we were backed by Goldman, so the sky was the limit. It didn't matter, but here it does, right? Here it does, because we
Yes,
don't
it
have
does.
unlimited money, and people sometimes have, a $5,000 account or a $50,000 account or a $500,000 account. Doesn't matter. It doesn't matter at all. It's all the same. You have to put up X amount of dollars to carry the position.
Right. So you're right. A lot of times our answer, in most cases, is it depends. And the reason is that is the answer for probably 95 or
Yeah,
99% of all
yeah.
options questions. But this is one of the few, because we get this a lot and people say, oh, but don't worry, it's a cash secured. And they say it in a way that implies that it's not as risky. And that is absolutely not true. So we just want to make sure that you are protected from yourselves or from
From
the
your
misperceptions if somebody tells you, don't worry about the naked puts, just do them cash secured. That's just a margin uh, requirement difference. It's got nothing to do with the risk. So I hope that helps. And
Yeah.
hopefully we'll see a little bounce off the opening bell here. And for the rest of you, we will see you at noon for
Yeah.
Q&A part 2, and we'll see you next week.